I want you to just picture a game of financial Jenga.
Okay, yeah, Jenga. I like that.
Right, so the tower is completely maxed out. It's swaying in the breeze,
Yeah.
and everyone in the room is just, staring at the top.
Naturally, that's where the action is.
Exactly. You're looking at those top blocks, right?
Right.
The massive tech valuations,
Hmm.
the daily stock market swings, all the crazy AI headlines.
Sure.
But the most critical piece in this entire structure isn't anywhere near the top. Actually, it's not even in the United States.
Right, it's miles away.
Yeah, the block that could literally send the whole thing crashing down is just sitting quietly at the absolute foundational base over in Tokyo.
It's really the perfect visualization, honestly, because, we have this inherent recency bias.
Oh, totally. We look at what's right in front of us.
Right, the blocks at eye level,
Yeah.
track the NASDAQ, we look at the daily AI product announcements, but we just completely ignore the structural integrity of the base.
Yeah.
And in global macroeconomics, the base is sovereign debt and foreign exchange.
Which brings us to the actual mission of this deep dive today.
Yeah.
We're unpacking this highly detailed, incredibly provocative presentation from investor and financial commentator Peter Schiff.
Yeah, this was from late July of 2026.
Exactly, late July 2026.
Mm.
And I just have to say, looking through these notes, it's really a masterclass in connecting macroeconomic dots that most people assume are just operating in entirely different universes.
Oh, completely.
So we're going to look at how a $750 billion AI spending spree, spiraling U.S. government debt, and a looming central banking crisis in Japan are all, intimately and, quite frankly, dangerously intertwined.
But, before we really get into the weeds on the mechanics here, we probably need to lay down a quick ground rule for everyone listening.
Yeah, good call. Let's set the table.
Because the source material we're pulling from today, it's dense, it's highly analytical, and crucially, it contains some very sharp critiques of both the Biden and the Trump administrations. Schiff goes after government spending, tariff implementations, and fiscal policy with equal ferocity, regardless of which party is actually holding the pen.
Right, and it's critical that we see it right up front. We're not taking political sides here.
Absolutely not.
We are not endorsing these political viewpoints, and we aren't condemning them either.
Exactly. Our job is just to be your impartial guides through the economic arguments.
Just the facts. Yeah.
Right. We are looking strictly at the math, the policy mechanics, and the potential market outcomes that Schiff is forecasting. We are stripping away the political theater to just look at the underlying plumbing of the global economy.
Because honestly, whether you are actively managing this heavily weighted equity portfolio, or you're just, trying to figure out why your grocery bill and your mortgage rates are acting so erratically, you really need to understand how this plumbing works.
You do, because when the pipes rattle in Tokyo, you feel it in Ohio.
That's a great way to put it. So let's start with the biggest, heaviest block near the top of that Jenga tower, the AI CapEx reality check.
Yeah, let's get into it. Because the scale of the capital expenditure we are seeing from the hyperscalers right now is genuinely unprecedented.
It's wild.
It really is. Schiff breaks down the numbers for Alphabet, Oracle, Meta, Amazon, and Microsoft. Collectively, these companies spent close to $500 billion last year just on AI infrastructure.
$500 billion.
Yeah. Data centers, cooling systems, specialized silicon, grid power. And the estimate for this year, it's $750 billion.
That's $750 billion. I try to wrap my head around that number,
Yeah.
and it's almost impossible.
It's hard to conceptualize.
Right. We're talking about a capital deployment that literally rivals the defense budgets of major superpowers,
Yeah.
and it's being spent by 5 companies in a 12-month window.
And historically, if we look back even just a year or two, when a tech titan announced a massive increase in CapEx to capture a new technological frontier, the market rewarded them.
Oh, they loved it.
Right. The stock would just gap up on the earnings call. The narrative was always, they are securing the future. But Schiff is highlighting a very sudden, very violent shift in how the market is actually digesting this spending.
Because the market has completely stopped cheering.
Totally.
Like Alphabet announces increased CapEx during their Thursday earnings, and they take a 10% haircut in a single week.
Wow.
Yeah, Alphabet is essentially flat for the entirety of 2026. Oracle, they got hammered. Down almost 8% on the week and a brutal 41% down on the year.
The market isn't just ignoring the spending anymore, it's actively punishing them for it.
Exactly. Meta was down 7.3%. Microsoft, which everyone usually treats as the ultimate tech safe haven, dropped nearly 3% on the week, and is down over 19% year to date.
And we're seeing similar collateral damage in Elon Musk's orbit, too.
Right, yeah.
Schiff specifically points to SpaceX and Tesla, both of which are, deeply intertwined with the AI narrative through projects like XAI and the massive compute required for autonomous driving.
Yeah, SpaceX takes this massive hit, dropping to $115 a share on the secondary markets. I mean, that's nearly 50% below its post-IPO high.
That's a huge drop.
It is. Tesla drops 18% in a week. Schiff actually calculates Musk personally lost almost $100 billion in paper wealth in just a matter of days.
Ouch.
Now, obviously, I'm not losing sleep over Elon Musk's net worth, but think about all the institutional and retail capital that chased that valuation up.
Oh, they are deeply underwater.
Yeah.
So to understand why the market is suddenly revolting like this, we really have to look at the concept of malinvestment.
Okay, lay that out for us.
So Schiff leans heavily into the Austrian economic framework here, and it's crucial to understand that malinvestment does not mean the underlying technology is a fraud.
Right, it's not a scam.
Exactly. Schiff explicitly states he believes AI is real and will likely have a more profound long-term impact on human productivity than the internet did.
Which is a massive statement.
It is.
So if the tech is real and the productivity gains are real, how is spending money to build it considered malinvestment?
Because the technological viability of a product just doesn't guarantee a return on invested capital.
Ah, okay.
Right. Malinvestment occurs when capital is deployed inefficiently, and that's usually driven by speculative panic, a fear of missing out, or just a distorted cost of capital.
The FOMO factor.
Exactly. These hyperscalers are spending $750 billion operating under a very specific economic assumption. They assume that they will be able to maintain this massive technological monopoly and charge premium pricing for their AI models indefinitely.
And Schiff argues that assumption is already falling apart, right?
Yeah.
Because of what he calls it's the DeepSeek, Moonshot, and Kimi K3 factor.
Exactly. Yes. These are Chinese-developed AI models, and what they represent is a hyper-accelerated commoditization of the technology.
Meaning they're making it cheap.
Right. The prevailing narrative in the U.S. has always been, we have the best talent, we have the best chips, we have a 6-month or 12-month lead on the rest of the world, therefore we win.
But wait, does a 6-month lead actually translate to pricing power in the real world?
That's the million-dollar question.
Right, because if I'm running a mid-sized logistics company, do I really care if the AI model can pass the bar exam in the top 1%? Or do I just need it to, route my delivery trucks slightly better than my human dispatcher?
That is the exact friction point Schiff is identifying. The U.S. hyperscalers are building these absolute supercomputers, digital savants.
Right.
But the Chinese models are entering the market as good enough alternatives. Maybe they are 6 months behind in abstract reasoning.
Sure.
But if they cost 90% less to query, the mid-sized logistics company is going to choose the Chinese model every single time.
Okay, let's unpack this with a thought experiment.
Okay.
Imagine a group of venture capitalists decide to build a multi-billion-dollar, state-of-the-art magnetic levitation bullet train network across the country.
Sounds expensive.
Right. They lay down the most expensive tracks in human history. They buy these incredibly sleek trains, and they model their financial returns on the assumption that shipping companies will pay a massive premium to move cargo at 400 miles per hour.
Okay, I follow.
But right as they finish the network, they realize that businesses are perfectly content putting their cargo on a fleet of dirt-cheap, slightly slower regional buses.
Because it's good enough.
Exactly. The cargo still arrives on time for the business's specific needs, the shipping company saves an absolute fortune, and the bullet train consortium is just left staring at billions in debt and empty train cars.
Yeah, the bullet train works perfectly. It's a literal marvel of engineering. But it's an economic disaster because the cost-benefit analysis of the end user just doesn't support that required premium.
Right.
If AI commoditizes faster than these U.S. companies can lock in enterprise contracts, they will be dragged into this brutal race-to-the-bottom price war.
Which kills the margins.
Totally. If you have to slash the price of your API calls by 80% just to stop your customers from migrating to DeepSeek, you are never, ever going to amortize that $750 billion upfront CapEx. It just becomes an unrecoverable sunk cost.
And Schiff makes the comparison to Cisco systems during the dot-com bubble, right?
Yeah, the parallels there are incredibly striking. I mean, in the late 90s, everyone knew the internet was going to change the world.
And they were right.
They were totally right. So telecommunications companies spent hundreds of billions of dollars laying fiber optic cables and buying routers and switches from Cisco.
Making Cisco a juggernaut.
Right, Cisco became the most valuable company in the world. But the telecom companies overbuilt. They laid dark fiber that wouldn't be lit for a decade.
So the demand just wasn't there yet.
Exactly. The end user demand wasn't there to justify the massive premium pricing they needed to pay off the debt they took to buy the Cisco gear.
Oh, wow.
So when the telecom companies went bankrupt, Cisco's customer base just evaporated overnight and Cisco's stock collapsed.
So in this modern scenario, the hyperscalers, Google, Meta, Microsoft, they are the telecom companies laying the fiber.
Yes.
So who is the modern-day Cisco?
The semiconductor supply chain. NVIDIA, Micron, TSMC, SK Hynix.
The chip makers?
Exactly. And Schiff points out the cracks are showing up there too. Despite the broader AI hype, NVIDIA was flat on the week, Micron was only up 3%, TSMC dropped 1.2%, and SK Hynix fell 4.6%.
It's starting to slow down.
Wall Street is finally starting to look past the current quarter's chip sales. They are realizing that if the hyperscalers can't generate a profitable margin on their AI products, they will eventually just stop buying server racks of H100s and B200s.
Right, the orders will dry up.
And if the CapEx spigot gets turned off, the chip makers are incredibly vulnerable.
But here's the thing. Let's say Oracle takes a massive write-down. Meta's margins compress. Why should you, the average listener, who maybe doesn't even own individual tech stocks, care if these specific companies face a reckoning over their bullet train investment?
That is a great point, and the answer is because the Magnificent Seven and their immediate peers are no longer just components of the U.S. equity market.
Right.
Functionally, they are the market. I mean, they have driven the vast majority of the S&P 500's returns for the last few years.
They prop the whole thing up.
Schiff points out that despite the bloodbath in these specific tech names, the Dow was only down 0.7% on the week, the S&P down 1.3%, and the NASDAQ down 3.1%.
So the indices don't look that bad.
Right. The broader indices are masking the rot underneath. If the AI malinvestment thesis fully materializes, the foundational pillars holding up your 401k, your IRA, and pension funds nationwide will buckle.
It's terrifying.
It really is an incredibly top-heavy market.
So we have the corporate sector, the most valuable companies in human history, borrowing and spending capital at unprecedented, potentially catastrophic rates.
Yeah.
But they are absolute amateurs compared to the biggest borrower on the board.
Oh, absolutely.
The entity that literally sets the cost of capital for everyone else.
Let's pivot and look at the U.S. government and this vicious cycle between energy, debt, and the bond market.
Yeah, to understand the debt spiral, we really have to start with the inflation narrative that the Federal Reserve and the Treasury are currently operating under.
Right. Because there is a massive disconnect between the headline data being celebrated and the forward-looking reality that Schiff is actually tracking.
Right, because if you looked at financial media after the June CPI report, they were practically throwing a parade.
Oh, they were ecstatic.
The print came in lower than expected. The narrative instantly became the dragon is slain, inflation is beaten, the Fed can aggressively cut rates now.
All right.
But Schiff actually looked at the individual components of that CPI drop.
Yeah, he stripped out the noise. The decline in the June CPI was heavily skewed by a very sharp, very temporary 20% plunge in energy prices during that specific month.
A 20% drop.
Yeah. It was an anomaly in the oil market, not a broad structural decline in the cost of rent or services or food. And as we entered July 2026, that anomaly rapidly reversed.
Oil just ripped past $90 a barrel.
Exactly.
It was up 30% for the month of July, largely driven by escalating geopolitical tensions in the Middle East, specifically, surrounding Iran.
Yeah, it spiked hard.
So Schiff's warning here is that the July CPI data is going to reflect that 30% surge in energy. The year-over-year inflation metrics are going to pull a massive U-turn. The whole party on Wall Street was just based on a mirage.
And while equity traders might have been celebrating the June CPI, the bond market was already sniffing out the July reality.
The bond market usually does.
The bond market is always the adult in the room.
Yeah.
Always. And this is perhaps the most alarming data point in Schiff's entire macro thesis. We are seeing Treasury yields hit levels that legitimately threaten to break the system.
Let's break down these yields because the scale of the move is just staggering. Schiff notes the 10-year Treasury hit 4.78%.
Yeah.
But the real shocker is the long end of the curve. The 30-year Treasury closed at 5.16%.
That is massive.
He emphasizes that is a 20-year high. We have not seen a 30-year yield north of 5% since 2006.
Right. The nominal percentage is one thing, But to really grasp the severity of a 5.16% yield on the 30-year, we have to look at the denominator.
The total pile of debt.
We have to look at the total debt load. Yes. In 2006, the last time rates were this high, the total U.S. national debt was hovering right around $8.5 trillion.
And today, in 2026, we are marching relentlessly toward $40 trillion.
Precisely. It is roughly a 370% increase in the principal debt balance.
Wow.
Paying 5% interest on $8 trillion is, a manageable line item in a growing economy. Paying 5% interest on $40 trillion triggers a systemic mathematical crisis.
Math just breaks.
It completely breaks. The sheer cost to service the debt, just the interest payments alone, without retiring a single cent of the principal, is skyrocketing. It is crowding out almost every other aspect of discretionary government spending.
And Schiff has a very brutal but honestly effective analogy for how we got to $40 trillion. He calls the Federal Reserve's long era of 0% interest rates free heroin.
Yeah, it's an aggressive metaphor.
Very aggressive.
But economically, it's pretty accurate. For over a decade following the Great Financial Crisis, the Fed kept the cost of capital at or near zero. Schiff argues that providing artificially free credit to an economy is exactly like handing out free heroin. Yes, it feels great in the short term. It numbs the pain of structural economic shifts.
Sure.
But just because a highly addictive, fundamentally destructive substance is offered to you for free doesn't mean you should inject it into the veins of your financial system.
But we did. We mainlined it.
We absolutely did.
Consumers levered up, corporations levered up to buy back their own stock, and the federal government went on a historic, unprecedented borrowing binge.
Yeah.
Now, if the government borrows at 0%, and uses that capital to build a new interstate highway system or next-generation nuclear power plants or, hard infrastructure that increases the productive capacity of the nation, you could justify it.
Because it pays for itself.
Right. The economic growth pays off the debt.
Yeah.
But Schiff points out that isn't where the money went at all.
No. The capital was overwhelmingly allocated to consumption, not production.
Consumption.
It went to massive stimulus programs, expanded social safety nets, geopolitical interventions, bailouts.
Right.
These are expenditures that, regardless of one's personal view on their societal necessity, they do not generate a future financial return. They don't build a factory that produces goods to be taxed later.
So it's essentially like a struggling company going to the bank, securing a $100 million loan at 0% interest.
Okay.
And instead of buying new manufacturing equipment to modernize their product line, the CEO just uses the $100 million to throw a lavish 5-year-long corporate retreat in the Bahamas.
Sounds fun, but bad business.
Exactly. Everyone has a great time, morale is high, but eventually the retreat ends. The bank comes knocking.
Right.
The principal is due, the company has 0 new revenue streams, and suddenly the bank says, by the way, to roll this debt over, your new interest rate is 5%.
And that company goes bankrupt, obviously. Now, the U.S. government can't technically go bankrupt because it can print its own currency, but the mechanics of the crisis are identical.
There's no revenue to pay it.
There is no underlying productive asset generating the revenue required to service a 5% interest rate on $40 trillion.
So what are the options?
The only conventional ways to manage it are extreme austerity, meaning slashing spending and massively hiking taxes, which is politically toxic, or then the central bank steps in to monetize the debt.
Printing money.
Printing money, which drastically increases the money supply and structurally devalues the currency. This leads directly to what Schiff calls the vicious fiscal circle.
I want to spend some time on this circle because it's the feedback loop that traps the Treasury.
It's the core of the problem.
How does this cycle actually function mechanically? Like, break it down for us.
Okay, it starts with the persistently high interest rates we are seeing right now. Because the 10-year and 30-year yields are near 5%, the Treasury has to allocate hundreds of billions of additional dollars just to pay the interest on the rolling debt.
Right.
Because this interest expense is so massive, the annual budget deficit expands dramatically.
So the hole they have to fill every single year gets deeper, purely because of the interest carrying cost.
Yes. Now, put yourself in the shoes of a global bond investor. You look at the expanding U.S. deficit, and you realize Congress has absolutely zero political appetite to balance the budget.
Not at all.
The only mathematical escape valve the U.S. has is to eventually pressure the Federal Reserve to print more money to cover the shortfall.
Which means the dollars the investor will eventually be paid back with will have significantly less purchasing power than the dollars they are lending today.
Exactly. So what does the rational investor do? They demand a higher risk premium.
They want to be compensated.
Right. They say, if I am going to hold this U.S. debt, and I know you are going to debase the currency to pay me back, I demand a 6% yield to compensate for that inflation risk.
So yields go up again.
Yields go up, which means the Treasury's interest expense goes up again.
Oh, man.
Which widens the deficit even further, which terrifies investors even more, causing them to demand even higher yields. The snake just eats its own tail. It is a self-reinforcing death spiral for sovereign debt.
But wait, if you turn on Bloomberg right now, you'll often hear analysts talking about the strength of the U.S. dollar.
You will.
The dollar index, the DXY, has actually shown periods of resilience even amidst these rising weights. People point to that and say, look, the dollar is strong, the world still wants our currency, the debt isn't a problem. Schiff completely rejects that premise, doesn't he?
He flips that conventional wisdom entirely on its head. In a normal macroeconomic environment, rising interest rates make a currency more attractive.
Sure, because of the yield.
Right. If U.S. bonds yield 5% and European bonds yield 2%, capital flows into the dollar to capture that spread, which strengthens the currency. But Schiff argues we are entering a phase where the rising yield is no longer an attractor, it is a repudiation.
Meaning investors aren't buying dollars because they want to. They are demanding higher yields because they are terrified of holding the debt.
Yes. It transitions from a yield premium to a risk premium. He believes we are nearing a tipping point where this correlation just breaks. Eventually, the reality of the vicious fiscal circle becomes so undeniable that foreign capital will simply refuse to fund the U.S. deficit regardless of the yield offered.
And then what happens?
When that happens, you see the nightmare scenario for a central banker. Interest rates spike violently higher, but the currency simultaneously collapses because the market loses total faith in the sovereign's ability to service the debt in real terms.
And this brings us to the most precarious piece of this entire puzzle.
The foundation.
Right. We've talked about the tech giants drowning in AI capex and the U.S. government trapped in a debt spiral. But the U.S. government hasn't been funding this $40 trillion deficit purely with domestic savings.
Not even close.
We have relied heavily on foreign entities to buy our treasury bonds. And historically, the most important buyer, the foundational block of this entire global debt structure, is Japan.
The Japanese catalyst.
Yeah.
If you want to identify the specific pin that could prick the U.S. debt bubble, you have to look at the Bank of Japan and the Japanese yen.
This is where macroeconomics gets incredibly fascinating to me. Most people don't think a central banking decision in Tokyo has any bearing on their daily life.
They really don't.
But Schiff lays out a scenario where Japan's currency crisis could literally dictate American mortgage rates and equity valuations. Let's look at the raw data out of Japan right now. The yen has cratered.
It's a historic collapse. I mean, the yen fell to 163.88 against the U.S. dollar.
163.
Yeah, that is a level we haven't seen in 40 years. We were talking about 1986, right around the time of the Plaza Accord.
Jeez.
And in tandem with the currency collapsing, the Japanese bond market is showing severe signs of stress.
The Japanese government bond, the JGB.
Right. JGB yields are spiking. The 10-year JGB hit 2.8%, which is a 30-year high.
Okay.
And the 30-year JGB almost breached 4%, which is the highest yield on record since Japan actually began issuing that specific maturity back in 1999.
How did one of the most advanced industrialized economies on Earth end up here? Schiff points out this isn't an accident, right? It is the mathematical conclusion of a deliberate, multi-decade central banking strategy that has just finally hit a brick wall.
Yeah, for decades, dating back to the aftermath of their massive asset bubble bursting in the early 90s, the Bank of Japan has engaged in zero interest rate policy and eventually yield curve control.
Keeping rates pinned down.
They intentionally kept their domestic interest rates artificially pinned to the floor, around 1% or even negative for long stretches. The economic theory behind this is classic mercantilism.
Right.
If you keep interest rates ultra low, your currency, the yen, remains structurally weak against the dollar and the euro.
And a weak yen is supposed to be the holy grail for a country like Japan, right?
Traditionally, yes.
Because they are an export powerhouse. If the yen is cheap, Toyota cars, Sony Electronics, Komatsu heavy machinery, they all become significantly cheaper for Americans and Europeans to buy. It stimulates their export economy.
That was the playbook for 30 years, and it worked when the global macro environment was relatively stable. But Schiff highlights the fatal flaw in this strategy in the current era. It's the terms of trade.
The terms of trade, okay.
A weak currency is incredibly advantageous if a nation produces everything it needs internally. But Japan's geography dictates its vulnerability. It is an island nation with very limited natural resources.
They have to import almost everything that powers their economy.
Exactly. They import almost all of their energy: oil, liquid natural gas, coal.
Yeah.
They import a massive percentage of their food and raw materials.
Right.
And crucially, they have to pay for those vital imports on the global market, which operates predominantly in U.S. dollars.
So here's where the math turns toxic. Schiff notes that because of the weak yen, Japan's exports did actually see a boost, right?
Yeah.
Export revenues rose 19.3%.
True.
But the cost to import their energy and raw materials soared by 25.4%.
The spread between those two numbers is just bleeding the country dry. The cost of energy is rising faster than the competitive advantage gained by cheaper exports.
It negates the whole benefit.
Completely. As a result, since 2021, Japan, historically one of the greatest export surplus nations in modern history, has been running consistent structural trade deficits.
Wow.
The weak yen policy is no longer stimulating the economy. It is importing crippling inflation and crushing domestic purchasing power.
But I want to push back on the idea of Japan being on the brink of collapse for a second.
Sure.
Because Schiff also notes they were still a vastly wealthy nation. He points out Japan is a net creditor nation, currently ranking number 3 globally behind China and Germany.
That's true.
The U.S., by contrast, is the world's largest debtor nation. Doesn't that massive creditor status give Japan a buffer?
It's a vital distinction. Being a net creditor means that Japanese citizens, corporations, and the government own more assets abroad than foreigners own inside Japan.
Right.
The Japanese public actually possesses one of the highest savings rates in the developed world. They are not swimming in consumer credit card debt like the average U.S. household.
They have money saved up.
The wealth is there. Investment income actually flows into Tokyo from all over the world.
So the people have a cushion, but the central bank is trapped.
Yes. The Bank of Japan is facing what Schiff describes as an impossible dilemma.
A lose-lose.
The central bank has two options to deal with the collapsing yen, and both paths lead to a massive global liquidity shock. Let's start with option A.
Okay, let's hear it.
The Bank of Japan decides to do the orthodox thing. They capitulate, abandon yield curve control, and aggressively raise domestic interest rates, say, up to 3% or 4%, to defend the yen and stop the inflationary bleeding on their import costs.
Okay, so what happens to the global financial system if they do that?
If they do that, Schiff argues it triggers the mother of all global margin calls.
A global margin call. Explain how that works.
Okay, walk through the mechanics of Japanese capital. Because domestic rates have been near zero for decades, Japanese institutional investors, pension funds, insurance companies, banks have taken trillions of dollars of domestic savings and invested them overseas in search of yield.
Chasing returns elsewhere.
Right. A massive chunk of that capital flowed into U.S. Treasury bonds. They were happy to buy U.S. debt at 3% or 4% because they were getting literally 0% at home.
But if the Bank of Japan suddenly hikes domestic rates to 3% or 4%, the math flips.
Instantly. If a Japanese pension fund can get a 4% yield on a domestic Japanese government bond, they have absolutely zero incentive to hold a U.S. Treasury bond yielding 4.5%.
Because of the currency risk.
Right, exactly. Because holding the U.S. bond carries currency exchange risk. If they can get a comparable yield in their native currency, they will take it every single time.
So you see a violent repatriation of capital. Japanese institutions start liquidating their foreign holdings to bring the money back to Tokyo.
En masse.
And the biggest holder of U.S. debt in Japan is the Japanese government itself, which holds over $1.1 trillion in U.S. treasuries as foreign exchange reserves.
Now, just imagine the Japanese government and private institutions simultaneously start dumping hundreds of billions, potentially trillions of dollars worth of U.S. Treasury bonds onto the open market to fund this repatriation.
The supply of U.S. bonds completely overwhelms the demand. The price of the bonds crashes.
And because bond prices and yields move inversely.
The yield on U.S. treasuries violently spikes upward.
Suddenly, the 10-year U.S. Treasury isn't at 4.7%. It's at 6%, 7%, or even 8%.
Which is catastrophic.
And when the risk-free rate of the global reserve currency spikes that aggressively, it breaks the back of the U.S. economy. Mortgage rates soar to 10% or 12%, freezing the housing market.
People couldn't afford to move?
No one could buy a house. Corporate borrowing costs double, triggering mass bankruptcies. The equity markets, especially the tech stocks relying on cheap capital for AI capex, completely cratered.
Right.
The U.S. falls into a severe recession, which only exacerbates the vicious fiscal circle of the deficit we discussed earlier.
So option A, Japan saving their own currency, effectively detonates the U.S. debt bubble.
Yes.
What about option B, What if the Bank of Japan is too timid, they refuse to hike rates, and they just maintain the status quo at 1%?
If they do nothing, the yen enters a free fall. We move from a currency devaluation to a potential currency collapse or a hyperinflationary spiral for imported goods in Japan.
Which destroys their economy anyway.
Exactly. The Japanese bond market crashes organically because domestic investors will dump JGBs to buy gold, dollars, or literally anything that holds purchasing power.
So the outcome is basically the same.
The resulting economic chaos in the world's third largest economy still triggers a massive liquidation of assets. Japanese entities will be forced to sell their U.S. holdings just to cover domestic losses and secure liquidity.
It's a true Kobayashi Maru, a totally leaves-lose scenario for the global financial architecture.
Very much so.
Japan is the foundational Jenga block holding up the U.S. debt market. If they pull their block out to save their own currency, the U.S. tower falls. If they leave the block in and let their currency turn to dust, the tower still loses its foundation and falls.
It perfectly illustrates the extreme fragility of a global macroeconomic system that has been built on decades of artificially suppressed interest rates and interconnected sovereign debt.
The imbalances are just too vast.
They are. They eventually have to reconcile, and historical precedent tells us that reconciliation of this magnitude is never, ever orderly.
So we have this incredibly precarious macro picture. AI malinvestment threatening the tech sector, a runaway U.S. deficit driving up borrowing costs, and the largest foreign creditor, Japan, on the verge of a currency crisis that could trigger a global liquidity drain.
That's a lot of storm clouds.
It is. Now, if you are listening to this and tracking all these points, a very logical question arises. Wait a minute. If the foundation is this cracked, why are the politicians on TV constantly bragging about a booming economy? Why are the employment metrics historically strong?
It's the essential question. And it brings us to Section 4 of Schiff's analysis, the gig economy illusion and the breakdown of traditional employment metrics.
Right.
Schiff asserts that the government is relying on legacy barometers that no longer accurately measure the modern labor force.
Let's look at the specific data point that sparked this critique. The Trump administration was publicly touting a massive drop in weekly initial unemployment claims, which fell to 187,000.
Yeah.
They framed this as a historic victory, calling it the lowest level of claims since 1969.
Now, Schiff quickly points out the political hypocrisy here, noting that the Biden administration actually oversaw a lower print. They had 182,000 claims in September 2022.
So both sides played the game.
Exactly. But his larger point is that arguing over who gets credit for the number is pointless, because the 187,000 figure itself is fundamentally meaningless as a gauge of economic health in the year 2026.
He argues that structural changes in how Americans work have rendered the initial jobless claims metric completely obsolete.
Yes.
He gives three main reasons why the claims are artificially misleadingly low. Let's walk through them. Reason number one is minimal hiring over the last cycle.
The logic here is straightforward. The traditional economic cycle features a boom phase of aggressive corporate expansion and hiring, followed by a bust phase of mass layoffs.
All right, hire a bunch, fire a bunch.
But Schiff argues the post-pandemic labor market, outside of a few specific sectors, hasn't seen robust, broad-based corporate hiring. If companies have been running lean and haven't added significant headcount, they don't have bloated payrolls to trim when the economy cools.
You literally can't fire people you never hired.
Exactly.
So you don't get a spike in unemployment claims, but that doesn't mean the economy is growing. It just means it's stagnant.
Precisely. Reason number two is the structural decline in labor force participation.
How does that skew the data?
Well, to physically file an initial claim for unemployment benefits, you must have lost a W-2 job through no fault of your own, and you must be actively seeking new employment.
Right. If you just give up, you drop out of the data.
Exactly. Millions of working-age adults have simply dropped out of the labor force over the last decade, whether due to early retirement, reliance on alternative income streams, disability, or simply just abandoning the job search.
They just aren't counted.
These individuals are economically inactive, but they are entirely invisible to the initial claims metric. A shrinking denominator mathematically lowers the claims number, which masks the underlying weakness.
But reason number three is the one that I think is the most profound, because it represents a permanent shift in the architecture of work, the gig economy.
This is the critical blind spot in legacy economic data.
Yeah.
Our entire statistical apparatus, unemployment claims, non-farm payrolls. It was designed in the mid-20th century. It was built to measure a factory-based or centralized corporate economy.
A different world.
Totally. In 1969, when the previous claims record was set, if a major manufacturer had a bad quarter, they handed out 500 pink slips.
Right.
Those 500 people walked down to the local unemployment office and filed 500 initial claims. The economic pain was centralized, immediate, and clearly visible in the data.
But the 2026 economy doesn't look like that at all.
No, it doesn't.
Millions of Americans are now effectively self-employed independent contractors operating on platforms like Uber, Lyft, DoorDash, Upwork, and TaskRabbit.
And the gig economy completely changes how economic contraction is actually experienced.
Let's use the Uber driver example.
Schiff uses the Uber driver as the perfect microcosm. Let's say the macroeconomy slips into a recession. Consumer discretionary spending tightens. People stop taking Ubers to restaurants and start cooking at home.
Right, so demand for rides plummets by, say, 20%.
In 1969, a taxi company would just lay off 20% of its drivers. But Uber doesn't do that.
No, because Uber classifies drivers as independent contractors.
Exactly. It costs Uber essentially nothing to keep a driver active on their server. They don't pay health insurance. They don't pay an hourly minimum wage. So when demand drops 20%, Uber doesn't deactivate 20% of its drivers.
What happens is that all the drivers simply get 20% fewer ride requests.
Exactly. The pain is distributed across the entire network. A driver who used to make $1,000 a week might only make $800. Or they have to sit in their car for 60 hours a week instead of 40 just to make the same amount of money.
But here is the crucial data anomaly. Because that driver is still technically earning some income, and because they were never formally fired from a W-2 job, they do not qualify to file an initial unemployment claim.
They are experiencing a recessionary loss of income. Their standard of living is actively declining, but they are completely invisible to the Department of Labor's weekly statistics.
So does the gig economy essentially act as a massive societal shock absorber?
In a way, yes.
I mean, it hides the localized trauma of centralized layoffs from the headline data,
Right.
but does it actually prevent a systemic crisis? Because if everyone's income is slowly bleeding out by 10% or 20%, the broader consumer economy is still going to contract even if the unemployment rate looks historically pristine.
Right. It acts as an incredible masking agent for politicians. It allows them to point to a graph and declare the labor market is booming.
Look at the chart.
Yeah, look at the chart. But the reality on the ground, the velocity of money, the ability of the average citizen to service their credit card debt or pay higher grocery prices is degrading.
It's failing.
The gig economy distributes the friction silently, allowing the structural rot to advance much, much further before it ever triggers official alarm bells.
It is an illusion of prosperity built on outdated metrics. And Schiff argues this illusion extends far beyond the labor market. It infects how the government manages trade and taxation as well.
Oh, absolutely.
Which transitions us to Section 5, which is tariffs, taxes, and fiscal reality.
This is where Schiff directly attacks the current administration's trade policy, focusing on the hidden economic mechanics of tariffs. And again, this is an analysis of the economic mechanism, not a partisan endorsement.
Right. The specific policy in question here is the Trump administration's implementation of sweeping new tariffs ranging from 10% to 12.5%, slapped on roughly 60 different countries.
Yeah.
And to enact these without going through the legislative friction of Congress, the administration utilized a specific legal mechanism, Section 301 of the Trade Act of 1974.
To understand Schiff's critique here, you have to understand the original intent of Section 301. Historically, it was drafted to address highly specific, fundamentally unfair trade practices, primarily revolving around the use of slave, forced, or highly coercive labor.
The economic logic being, you cannot expect a free market American manufacturer who pays a minimum wage, adheres to OSHA safety standards, respects labor rights, to compete on price with a foreign entity that uses literal slave labor.
Exactly. A targeted tariff in that scenario is designed to offset the immoral cost advantage of forced labor, effectively leveling the playing field.
That makes sense.
But Schiff argues the current application of Section 301 has been completely divorced from this original intent. It's been weaponized as a blanket loophole to bypass the constitutional requirement that all revenue-raising measures, meaning taxes, must originate in the House of Representatives.
And he points to the tariff levied on Switzerland as the ultimate proof of this absurdity, right?
Yeah. Switzerland was hit with a 12.5% tariff. The legal justification used under Section 301 was the claim that the Swiss government wasn't doing enough to prevent products made with slave labor from third-party countries from entering their own domestic borders.
Which Schiff essentially laughs at because it's a
Wow.
staggering legal stretch.
It's a pretext. I mean, Schiff points out the obvious reality here. Swiss workers are among the highest paid in the world.
Yeah, they do quite well.
Their average wages often exceed American wages. There is absolutely no slave labor cost advantage embedded in a Swiss watch, Swiss machinery, or Swiss pharmaceuticals.
Right.
The application of Section 301 here is simply a legal sleight of hand to implement a tax without congressional debate.
Because we have to call a spade here. In the realm of macroeconomics, a tariff is not a penalty paid by a foreign government. It is a tax.
Political rhetoric frequently obscures this.
Always.
A politician will stand at a podium and declare, "We are taxing China, we are taxing Europe." But the mechanics of a tariff dictate that the foreign exporter does not write a check to the U.S. Treasury.
Who pays it?
The tariff is paid by the domestic American importer when the goods arrive at the port of entry.
The American business pays the fee.
Yes. If a U.S. logistics company imports Swiss machinery, the U.S. company pays the 12.5% tariff. And what does a business do when its supply chain costs suddenly increase by 12.5%?
They pass it directly onto the consumer. They just raise the retail price of the final product.
It functions exactly like a national sales tax, but it is hidden within the retail price.
So sneaky.
And Schiff's broader fiscal thesis connects this directly to the spiraling deficit we discussed earlier. He argues these tariffs are being aggressively rolled out as a stealth mechanism to fund the massive government deficits driven by what he calls the Big Beautiful Bill, the rampant spending expansions of the current era.
So it's a massive political shell game.
Right.
A politician goes on television and takes credit for highly visible, popular tax cuts. We eliminated taxes on tips, we cut taxes on Social Security benefits, we protected Medicare.
And the voters cheer.
The voters cheer. But the politician knows these tax cuts will blow an even larger hole in the deficit. So, out of view, they unilaterally impose a 10% tariff on goods imported from 60 countries.
The citizen gets a marginal tax break on their paycheck, but they lose all of that benefit, and likely much more, when they go to Home Depot or Target or the grocery store.
Because everything is more expensive.
Right, because the cost of all imported goods and domestic goods that rely on imported components has been artificially inflated by the tariff.
It reminds me of a corrupt town mayor.
Okay, lay it on me.
The mayor announces, "I am lowering property taxes for everyone, and to pay for the town's massive new municipal building, I am setting up a toll booth on the main highway leading into town. We're going to punish those out-of-town merchants."
Right, stick it to the outsiders.
Exactly. So the townspeople re-elect him. But the out-of-town merchants who bring the flour, the lumber, and the clothing into town simply look at the toll fee, tack it onto the price of their goods, and drive right through. The only people who actually end up paying the mayor's toll are the local townspeople when they go to buy their bread and clothes.
That is the precise mechanism. And Schiff notes that not only does it act as a regressive tax on the American consumer, but it also fails to solve the underlying fiscal crisis.
Doesn't even work.
No, tariffs make American businesses less competitive globally by raising their input costs. They invite retaliatory tariffs that crush American exporters, and they just never generate enough revenue to offset the structural spending deficits of the U.S. government.
So take a step back and look at the landscape Schiff has painted here.
It's bleak.
The tech sector is teetering on a massive AI malinvestment bubble. The U.S. government is trapped in a vicious cycle of debt and interest payments. The foundational buyer of that debt, Japan, is facing an existential currency crisis that could trigger a global liquidity collapse.
Right.
The domestic labor market strength is a gig economy illusion, and the consumer is being secretly taxed via tariffs to fund the spiraling deficit.
It's a perfect storm.
If you are an institutional investor, the so-called smart money, managing billions of dollars of wealth in this environment, where on earth do you hide?
That is the ultimate question, and it leads us directly into Section 6, gold versus crypto and the safe haven divergence.
Okay, let's talk safe havens.
Because when the macro environment is defined by the fear of sovereign debt defaults and rampant currency debasement, capital searches desperately for a store of value outside the traditional fiat system.
Let's look at the scoreboard from the specific week of Schiff's presentation, because the price action is incredibly telling. Gold rose 1% and silver jumped 2.4%.
Yeah.
And crucially, the gold mining stocks indices like GDX and GDXJ, They surged nearly 6% on the week.
The performance of precious metals in this specific week is what we call a major decoupling, and Schiff views it as highly significant.
Why is it a decoupling? Like, why does that matter?
Because of the context in which it happened. Remember, during this exact same week, the 10-year and 30-year Treasury yields were spiking to multi-decade highs, and oil was surging.
Right, rates were going up.
Historically, gold and interest rates have a very strong inverse relationship.
Because gold doesn't yield anything, it just sits in a vault.
Right. If you are an investor and you can buy a U.S. Treasury bond that guarantees you a 5% yield, the opportunity cost of holding a non-yielding asset like gold is high. Usually, when real rates spike, institutional capital dumps gold and buys the yield.
But that isn't happening here. Gold is rising alongside the spiking yields.
Which tells Schiff that the nature of the yield has changed, echoing our earlier point. The market isn't viewing the 5% Treasury yield as a risk-free return. They are viewing it as a desperate risk premium.
They're scared.
Exactly. The fact that gold is catching bids despite the high yields indicates a deep, systemic, institutional fear that the U.S. government will eventually be forced to debase the currency to monetize the $40 trillion debt.
So they'd rather have the metal.
Investors are deciding they would rather hold a physical asset that yields nothing but cannot be printed than a sovereign bond yielding 5% in a currency they believe is going to be structurally devalued.
The fear of fiat collapse is literally driving capital to physical scarcity, which naturally brings us to the modern challenger, the safe haven debate. Bitcoin.
The digital gold.
Right. If the institutional fear of currency debasement is truly this high, if people are terrified the dollar and the yen are trapped in death spirals, shouldn't this be the exact macroeconomic environment where Bitcoin absolutely thrives?
You would think so.
It's decentralized, it operates outside central bank control, and it has a hard cap of 21 million coins. Yet, Schiff points out that Bitcoin is acting like a completely different animal.
It is the defining financial debate of the decade. Schiff notes that while gold and silver were rallying in the face of rising yields, Bitcoin had a completely stagnant week, hovering right around $64,300.
Just flat.
More importantly, it was down 29% year-to-date at the time of the presentation. But Schiff's real focus isn't just the spot price of the token, it's the behavior of the institutions building leverage around it.
Who is he looking at?
He takes dead aim at MicroStrategy.
Which he mockingly just calls strategy or stretch, right? Because he argues they have completely abandoned their original software business to operate exclusively as a leveraged Bitcoin hoarding vehicle.
Yeah, he's pretty harsh on them. The stock of MicroStrategy is down 42% year-to-date in his timeline. But the specific metric Schiff highlights, and this requires an understanding of corporate debt markets, is the yield on MicroStrategy's corporate bonds.
He points out that MicroStrategy's bonds are yielding nearly 14%.
Now, stop and think about the mechanics of a corporate bond yield. When a company issues a bond, the interest rate they have to offer is entirely dependent on how the credit market assesses their risk of default.
Right. If you're risky, you pay more.
Exactly. If Wall Street institutions truly believe the narrative they sell on CNBC, that Bitcoin is the ultimate, pristine digital gold, the safest reserve asset on Earth, then they would view MicroStrategy as the most solvent, secure company in the market.
Because MicroStrategy holds billions of dollars of this supposedly pristine asset on its balance sheet. If the asset is safe, lending money to the company holding it should be safe.
Exactly. If the market believed the Bitcoin narrative, MicroStrategy should be able to issue debt at 4% or 5%.
But they can't.
No. The fact that institutional bond buyers are demanding a 14% yield, which is deep into distressed junk bond territory, proves that the smart money and the fixed income world views MicroStrategy's underlying asset base as highly volatile, speculative, and deeply risky.
So Schiff's argument is that there's a massive divergence between what Wall Street CEOs say about crypto to attract retail trading fees and how their actual bond trading desks are pricing the risk.
That is precisely his thesis. He argues that despite the ETFs and the media hype, Bitcoin remains a speculative risk asset primarily driven by retail sentiment and excess liquidity.
When the money printer is on, it goes up.
Right. And when the liquidity dries up and real sovereign debt fears take hold, institutional capital doesn't flee to Bitcoin. It flees to the historical certainty of physical gold, which is entirely unencumbered by corporate leverage or digital counterparty risk.
It is an incredibly intricate, interconnecting web that Schiff weaves here. I mean, it forces you to reevaluate almost every major financial headline. Let's try to pull these threads together and just view the entire tapestry.
The defining through line of the entire presentation is really the consequence of debt-fueled malinvestment crashing into the reality of a globalized, fragile, sovereign bond market.
Right, so we start at the top of the Jenga tower. Tech behemoths are spending $750 billion on AI infrastructure, terrified of missing the next paradigm.
Yeah.
But they are potentially building the most expensive bullet train network in history. Right as the global enterprise market decides it is perfectly happy buying cheap bus tickets from commoditized Chinese competitors.
And this massive corporate expenditure is happening in a high-cost capital environment, an environment caused by the U.S. government's total inability to constrain its own deficit spending.
The vicious circle.
Exactly. The Treasury is trapped in a vicious fiscal circle, forced to offer increasingly painful yields just to attract buyers for its $40 trillion debt load.
And the most critical buyer of that debt, the foundational Jenga block of Japan, is facing an existential crisis. The Bank of Japan's decades-long experiment with zero interest rates has backfired, crushing the yen under the weight of imported energy costs.
It's all connected.
If Tokyo raises rates to save their currency, they trigger a repatriation of capital that dumps trillions in U.S. treasuries onto the open market, instantly spiking American borrowing costs and popping the tech bubble.
Meanwhile, the domestic indicators that would normally warn us of this impending structural failure are just flashing false
The
positive.
jobless claims.
Right. The gig economy has fundamentally altered the labor force, acting as a silent shock absorber that distributes the pain of reduced consumer demand via lower independent contractor wages. It completely masks the localized trauma from legacy metrics like initial jobless claims.
And while the politicians point to those broken metrics to claim victory, they are quietly utilizing historical legal loopholes to slap tariffs on imported goods, essentially levying hidden consumption taxes on the American public to desperately funnel revenue into a deficit that cannot be mathematically contained.
It is a profoundly fragile ecosystem where the traditional rules of engagement, like the assumption that rising interest rates will always crush gold, are beginning to violently break down under the sheer accumulated weight of these structural macroeconomic imbalances.
It certainly makes you look at the daily market ticker with a completely different perspective. You've given us an immense amount of mechanics to digest today.
I will leave you with this final provocative thought, which builds directly on the themes Schiff has laid out.
Okay, let's hear it.
If we accept the premise that the U.S. government is increasingly relying on hidden consumption taxes like tariffs to quietly monetize its deficit, and if we acknowledge that structural shifts like the gig economy are completely obfuscating the true realities of working-class income from official unemployment data, we are forced to ask ourselves a very uncomfortable question.
What is that?
How many of our other daily economic barometers, the CPI inflation metrics, the GDP growth numbers, the very data points that dictate our personal financial decisions, our asset allocation, and our career trajectories, how many of them are actually measuring the reality of the 2026 economy versus merely reflecting the mathematical shadows of a mid-20th century legacy system that just no longer exists?
Wow. Are we navigating a Category 5 hurricane using a barometer built in 1960? That is the question you have to take with you.
It's something to think about.
You cannot just stare at the shiny blocks at the top of the tower. You have to investigate the foundation. Thank you so much for joining us for this deep dive. Keep questioning the headlines, keep looking deeper into the structural mechanics of the global economy, and we will catch you next time.